Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. Financial markets have experienced a volatile start to the year, with risk appetite ebbing and flowing, and US President Donald Trump never far from the headlines. To discuss this, with a focus on interest rates and currencies in particular, I'm joined by Imre Speizer, who's Head of New Zealand Strategy at Westpac. Hi Imre, and thanks for joining us, and welcome back to the Of Interest podcast.
Hi Vaughan, thanks for having me.
Look, there's an old saying that financial markets are driven by either fear or greed. I'm just wondering, is either of these in ascendancy at the moment? It seems to fluctuate quite a bit.
I wouldn't pick which one is an ascendancy, but they are both prevalent, or they have been over the last few months, and it's likely that they will remain so during the year ahead. Yeah, very interesting times, as I'm sure everybody knows. Many global developments, whether they're geopolitical or financial market-wise or economic, but we're seeing major ructions, reordering of the world led by the US, and there's all sorts of fallout going on. But we're starting to make a little bit of sense of some of those things and how they're likely to influence currencies, in particular the Kiwi dollar and Kiwi interest rates over the year.
Yeah, well, that's great, because that's obviously the key things we're interested in talking to you about. So, look, I mean, I guess that the risk sentiment, that ebbs and flows too, and we've seen big moves in gold and silver and the like as well early in the year. What is that sort of risk sentiment like at the moment?
It's right here and now, cautious. Obviously, equity market sentiment has been very, very strong. That's taken a bit of a breather. Too early to call time on it and say this is going to be the start of a very big reversal and correction. So I won't be thinking about making that call. But sentiment overall in the market is guarded. It's been battered by some very big events, both on the geopolitical side and on the US policy-making side, notably tariffs, which had sent a major shockwave through the world back in April. What has probably changed, and this is very noticeable in currency land, is whereas in the past, when you got a big global shock, the money flowed into the safe haven, which is the US dollar. However, on this occasion, the US was actually leading the way in making a fairly significant policy change on the trade front, and markets weren't as confident in seeking the US dollar as a safe haven refuge during the turmoil. So what actually happened, perversely, was that the US dollar got quite heavily sold for much of the year. And it wasn't just the tariffs. The tariffs were a major catalyst, but we also had just the volatility of US administration policy making. The markets were just continually surprised with the back and forth. In addition to that, you also had the Federal Reserve outlook being influenced or seemingly influenced by the administration as well. And so all of that basically unnerved global investors about directing their money into the US dollar, and we saw some exiting. We wouldn't want to overplay it and say the days of the US dollar as a safe haven currency are numbered. No, but certainly during that period, it was notable for the breakdown in the typical relationships where risk off meant US dollar went up. That didn't happen. We had risk off and US dollar went down. So right here and now, it feels like maybe we're past the worst, and but markets are still fairly guarded about how they're treating that US dollar. So relationships between risk and currencies right here and now are fairly mixed. I think that's the safest way to put it. They are, though, focusing on economic outperformers and underperformers. And that was very notable last year, particularly in the case of the Kiwi. The Kiwi was an underperformer last year because its economy was an underperformer. For some time, we'd been waiting for this New Zealand economic recovery. It didn't materialise till very late in the year. it really wasn't obvious till probably late November, December. And so for much of the year, the market basically picked on the Kiwi as the currency to sell. Bear in mind also that Kiwi has lost its interest rate advantage relative to the likes of the US and Australia. It's now at a disadvantage. So it was a fairly easy currency to pick on during both good times and bad times. Kiwi just underperformed. So now that was the story of last year. From being a pariah of the GT and currency markets, suddenly this year it's become the darling of the markets. Indeed, depending on what day you're looking at it, I looked at it 2 days ago, year to date, it was the best performing GT and currency full stop. So what switched? Markets have now recognised that this long-awaited New Zealand economic recovery is actually in motion. And as I say, we started to see evidence of that from November onwards. And by the beginning of this year, it was quite apparent that, yes, the evidence is in. Now, that doesn't mean that it's going to sustain itself with the same velocity, but we do have evidence that at least the recovery has started, and we're confident about that. So yeah, the Kiwi is doing pretty well in this new environment. There is still a little bit of residual scarring on the US dollar from all of the stuff that's happened over the last 9 months. So, you know, the Kiwi and the Aussie and a few others are benefiting from that. Overall, the Kiwi-US exchange rate looks in reasonably good shape for at least the quarter ahead. And, you know, we're putting a higher number on it for the end of the March quarter, something like up to about 62 cents. And by year end, just a bit higher, up to around 63 cents. And then into next year, we're looking at higher Kiwi-US exchange rate still. So the trend we're seeing in the Kiwi-US is pretty clearly upwards.
That's really interesting. And I mean, Australia too, I think, is an interesting one because we're speaking on Wednesday, February the 4th. So yesterday, our time, we had the Reserve Bank of Australia increase its cash rate by 25 basis points to 3.85%. So really interesting thing, I think, here from a New Zealand perspective is the Reserve Bank of New Zealand obviously has its official cash rate now at just 2.25%. So we have a big gap of 160 basis points. Is this unusual? I mean, when did we last see a gap like that between the cash rates in New Zealand and Australia? And how much, how could this influence New Zealand interest rates and indeed the New Zealand dollar?
Yeah, you bet it's unusual. The last time we saw this kind of interest rate difference, depending on what maturity you're looking at, was 13 or 14 years ago. So really another era. Why is that? Particularly against because the Aussie, which often we've tracked pretty close to, the two economies tend to cycle together most of the time. It's probably it comes down to a different central bank approach. The RBA has deliberately maintained a fairly dampened approach to tackling either low inflation or high inflation. So when it's needed to hike or cut, it's done it in a very cautious and drawn out manner. And by doing so, it hasn't had to kind of, flip around as much as the likes of some other countries. New Zealand's not alone. Canada is in the same boat and a few others. But, the Central Bank of New Zealand has been fairly much an activist in terms of tackling inflation. So when inflation was high in the most recent cycle, it went fairly hard and hiked rates a lot to bring it back down again. And that then, amongst other things, did help to engineer a brief recession. So there's it paid a cost to do so, but it got inflation under control. Now we're basically coming out of that era, and as I say, growth is starting to pick up. And so the Reserve Bank is now faced with the task of thinking, well, at what point do we need to start thinking about pushing rates up to prevent inflation from running away? So I guess it just means the assertiveness of the relative central banks has probably explained why we've ended up with such big differences between New Zealand interest rates and say the Australian interest rate. In time, that will rectify itself, and we'll get back to something that looks a bit more normal, i.e. Kiwi rates a little bit higher than Aussie rates. But I think it's going to be some way down the track. Yesterday, as you said, we had the RBA. It hiked. That was widely expected. Perhaps what was a little bit more hawkish than the markets and analysts had expected was not really guidance, because they deliberately refrained from doing so, but just taken in totality, all of their forecasts suggested they probably need to go again. And that was a big question for the markets. Is this just going to be a one-off hike, or is it the beginning of a cycle? Now, it's too early to say it's going to be a beginning of a normal size cycle, but at the very least, it does look like they're going to hike again in May. Our chief economist changed her forecast yesterday after the RBA outcome and after the press conference, and went from one hike in the cycle to so far two. So that's where we're sitting at the moment. Markets are just a little bit above the two in this cycle mark. I think they're pitching it at about 2.5 at the moment. But it does look like it will probably be still a fairly small interest rate cycle relative to the kinds of cycles that we've seen in New Zealand. Now, our cycle is not going to kick off till late this year. It's very unlikely that we'd see, even though we're seeing evidence of a recovery, it's very unlikely that we're going to see enough strong evidence in the very short term to compel them to go, say, around the middle of the year.
So you're talking about Reserve Bank of New Zealand hiking the OCR?
Sorry, the Reserve Bank of New Zealand, So the Reserve Bank of New Zealand is probably going to start its own hiking cycle in the fourth quarter of this year. Now, our economists have penciled in December as the starting date. The markets have actually predicted September. That's quite plausible. And even our own economists would admit that there's a skew in their forecasts, such that it's more likely that they would kick off before December rather than after December. So sometime around the fourth quarter, we're likely to see the RBNZ starting its cycle. And how much are they going to do? Well, our forecast is that they'll do roughly one each quarter till it takes the OCR to 3 3/4, which is close to, or maybe just a smidgen above, what we perceive to be long-run neutral for the cash rate. So we're going to probably end up having a larger cycle. It might not necessarily take the OCR to above the RBA's cash rate, but we're coming from a much lower base. And I think just the magnitude of our cycle will then ripple down the curve, and you'll see these term rates, like your 2-year swap and 5-year swap and so on, actually rising a lot more than will Australian term interest rates. And that's where I think, particularly out the term land, we might actually reclaim a little bit of an interest rate advantage again. But it'll take time. That's not something that I'd expect to happen in the next 1 or even maybe 2 quarters, but maybe sort of in the second half of the year.
So in terms of the currency side of things, so you're expecting New Zealand dollar against the US dollar is a story of increasing strength in coming months. What about New Zealand dollar against the Aussie dollar?
Yeah, in the very short term, the market's just dwelling on this new, call it a modest hawkish surprise from the RBA. So I think that's going to dominate. And you could see the Kiwi Aussie going down to maybe a little bit more, down to about 85 cents. But by year end, we think it'll have picked up, and we might get something closer to like 87 or so. And then the year after, continuing in an upward direction. So I think we might reclaim some ground, just because, as I say, we're starting our OCR hiking cycle from a much lower base. We'll have more to do, and that will feed into the relative currency strength in the cross rate.
What about New Zealand swap rates? Obviously, as a base for other interest rates, they're really important. And so, where can we expect those to go in coming months, and what impact is that likely to have on mortgage rates?
Yeah, markets, as you know, are very preemptive. As a very, very crude, rough rule of thumb, you could say that markets predict the next interest rate cycle by around a year. So the market's already on this trade. It's already of this mindset where it's thinking about the first RBNZ rate hike, and it's already started to push up term rates. So we've seen a bit of this playing out already. It started playing out from about October or November last year. I think that'll continue for much of the year, assuming we don't get any negative surprises out of the data. If things play out as we expect, we'll just see gradually higher and higher term rates. If you're thinking about which ones will move the most, the ones with the shortest maturity will move the most. So, for example, 1 year rates, 2 year rates, 3 year rates will move up more and quicker than will sort of 7 year and 10 year rates, for example. So what you'll have is the yield curve, which we call, it's very steep at the moment. There's a very big difference between a short maturity and a long maturity. That difference will narrow over time, and we'll end up with a slightly flatter curve. And that'll all feed into mortgage rates. Mortgage rates are very sensitive to swap rates. It's not exactly immediate, but it's pretty close. So, if swap rates record a large movement, then mortgage rates will adjust accordingly as well. So what we'll end up with is higher mortgage rates and perhaps a flatter curve of mortgage rates where something like the 2 year is actually not as far away from the 5 year as it is at the moment.
So you mentioned the yield curve. I mean, that's often seen as a pointer to upcoming economic performance. What is the yield curve telling us at the moment?
Well, it's very, very steep. So textbook theory would say expect an economic growth cycle during the years ahead. That's what it's saying. And that is consistent with everything I've said. We've seen the signs of the beginning of the recovery, and we expect that to play out over the next couple of years. So that is what the yield curve is telling us.
Keen to have a look back, I guess, a bit more at the US. I mean, obviously the US dollar, the US equity markets, the massive US treasuries market are, these are the biggest, most liquid financial markets in the world. So they're hugely influential. As you say, I mean, it's been a period of, I guess, uncertainty, volatility, and obviously, the age of Trump, that seems to be what we're getting. We've got a new Federal Reserve chairman coming in, Kevin Warsh, in May, assuming that he's confirmed by Congress. I mean, how, I guess for someone like yourself who's been watching financial markets for a long time, how unique is this time period? I mean, obviously there's been lots of ups and downs and in the markets over the years, but is this situation different to anything you've seen before?
Well, in the case of the US, somewhat, but you can draw some parallels. I mean, Trump appointed Jay Powell, and that relationship basically probably didn't proceed as both parties would have expected over the years. So he's very happy and he's confident in appointing Kevin Warsh. I think we've just got to give this one time to see how this one pans out, 3 years from now, 4 years from now. The very early thoughts on it, though, clearly the market has liked it. He's a credible candidate. He's viewed as much more mainstream rather than unorthodox. He's probably not seen as being appointed just for loyalty to Trump reasons. So he's been a Fed governor before. There's all the chatters about how did he behave last time. Yes, he was known as an inflation hawk many years ago. Whether he's still of that ilk, who knows? We'll see when he, if and when he takes the job and makes his first sort of on the record speeches and the like. If there's any kind of skew to his, policy bias. Markets like to attribute, he's either more of a dove or more of a hawk. Maybe he's just a right down the middle centrist. But again, we've got to wait and see when he takes the job and starts talking, just what kind of flavour comes out. But as it is right now, I think he's viewed well, viewed credibly, and that's been one of the reasons why the US dollar had a bit of a bounce over the last week. markets are thinking actually from two channels. Firstly, yes, a credible leader, that is a good thing. So that's helped the US dollar. And secondly, it's not a slam dunk that he's going to be, cutting rates furiously as the administration has been trying to pressure the Fed to do. So, on both of those counts, that it has been, moderately US dollar supportive.
We've also seen, obviously, some US government shutdowns or partial shutdowns, and this leads to delays to the releases of key US economic data. Notably, at the moment, the US Bureau of Labour Statistics monthly jobs report. These are obviously big influences on financial markets and keenly watched. How disruptive is this when this happens?
Oh, very much so. Even the Fed talks about it and tells people that makes their decision making very tough because it's flying half blind. This one will be probably short and sharp, and again, it was only a partial shutdown. So, but it has affected so far the release of this week's monthly payrolls report, which is probably the most important of all the data points that the Fed looks at. But that's been delayed to be advised. It also has another longer-term influence that it just adds to the scarring of the US dollar's safe haven identity. So it's been damaged already. It's recovered partly. More of these kinds of things, they do tend to diminish the credibility of the US dollar as the asset that you would want to put all of your money into for safekeeping. So it just really adds to that longer running, almost structural theme going on.
In terms of the local data, we obviously had the latest labour market report out from Statistics New Zealand today. We've had the Consumers Price Index out for the December quarter showing an annual rate of 3.1%. I guess I'm curious, what's going to be the key data to watch in New Zealand this year? And obviously that 3.1% inflation is above the Reserve Bank's target. Markets don't seem to be particularly worried about that right now.
I think the markets have already reacted to it, and that is one reason why term swap rates, particularly the likes of the 2 and 3 year maturity, have recorded a fairly decent rise since about October, November. In fact, when the Reserve Bank meets again to make its next decision, which will be the 18th of February, and that'll be a monetary policy statement, and at those events, it publishes a track of where it thinks the OCR is going to go over the next 3 years. Very helpful piece of information from the Reserve Bank. We think that they will revise that track higher than it was at the last update, which was in November. Exactly how much higher, we're still playing around with some of the numbers. But the two really big surprises, which are pushing it higher, we think, have been the CPI surprise and also the GDP surprise, which we got back in December. That was higher than the Reserve Bank had penciled in. So those are the two really big things. There are a lot of little things that go against it, but when you add them all up, you're left with the impact on their OCR outlook is unambiguously going to be higher when they meet and publish it in later on in February.
What are the sort of key pieces of data to watch in coming months?
The big ones are always, the biggest one of all is always the CPI inflation number. Why is that? Because that is its mandate. It has a sole mandate now. Its target at ensuring it remains in a particular band with a focus on the midpoint, 2%. And so if other things suffer, so be it. So inflation is always going to be the number one thing. But the other two big things will be the labour market via those quarterly reports, which we had one out this morning, and the GDP report, which also comes out quarterly. GDP data has been volatile, subject to fairly decent back revisions, but we think it's going to be trending in a positive direction. CPI inflation has been sticking around the high twos, probably higher than the Reserve Bank would like it to stick. I'm talking about the core measures. Headlines are higher, but it's probably a bit higher than the Reserve Bank would like to see, and they'd like to see it coming back to around 2, which again is going to be one of the things that'll compel them to hike rates later this year. So yeah, those things are going to be very important. And the labour market. Labour market's very important because it's overall a sign of how much capacity is there left in the economy or not. Right now there still is a bit of capacity. It's not getting any worse. The most recent labour report that we had, this morning's labour report, while it showed that the unemployment rate went up, that was just a function of participation going up quite a lot. Employment itself went up, but participation went up even more. So you get this higher unemployment rate number. Overall, the report was about what we would have expected, and we think it's about what the Reserve Bank itself would have expected, taken in totality. So yeah, not a major surprise. What we're seeing from that report and other labour reports, which come out a bit more frequently, is that the labour market is finding a base. It is becoming more stable than it has been, and it'll start turning the corner during the year ahead. But it's a slow moving beast, and wage pressures are certainly not evident. They're fairly well contained. So that's one thing that'll give the Reserve Bank some comfort that inflation's not running away. But yeah, that labour market will gradually start to improve during the year ahead. In terms of timing, I suppose, because a number of people ask us, at what point will you have confidence that this beginning of economic recovery is sustainable, that it'll actually last the whole year and longer? Probably not till you get to about mid-year, May, June, because by then you'll have a few more of these GDP, CPI, and labour reports, which are all quarterlies. You've probably got to wait for then to see all of those and be able to form a conclusion on how things are going to look by Christmas.
In terms of the stronger outlook for the New Zealand dollar and the better outlook for the New Zealand economy, and you throw in the volatility in the US, how is that likely to impact New Zealand government bonds?
New Zealand government bonds are faring pretty well at the moment. They are enjoying pretty strong demand, particularly from offshore investors. And we think that will continue for pretty much the whole year ahead. So why are they in demand? They're cheap, number one. We usually look at government bonds relative to the equivalent maturity swap rate. So, take a 10-year. It was only a few months ago that government bonds were about 60 basis points higher than a 10-year swap rate. That's very unusual. In fact, it's very unusual to have a government bond rate higher than a swap rate. It should be the other way around because it's a risk-free interest rate. But these have been strange times. I won't go into all the reasons why it's flipped around. It's not just unique to New Zealand, but in New Zealand's case, it was quite a large flip around. So New Zealand government bonds have been really cheap. The yields have been very high relative to swaps, and that started to attract some offshore investors. Then the steepness of the yield curve, so the difference between, say, a very high 10-year rate and a low 1-year rate or a 6-month rate was very, very large. What it means is you can buy a 10-year bond, and if you do nothing and hold it, time itself will make you money as it rolls down this yield curve. So, if you bought it at 5%, months later it might become, 4.8%, even if the market doesn't move. And this thing we call roll down is a very attractive feature for investors. And on top of that, you enjoy positive carry. So if you buy this 10-year bond, you fund it with, 1 day or 1 week money, and you enjoy a very large spread. So this carry and roll aspect has been a very attractive feature, which has brought in a lot of new investors to the Kiwi government bonds. And the third thing would be supply. So, over the last few years, Kiwi government bond issuance has risen significantly, mostly in response to the pandemic and the QE programs that were enacted then. But we've ended up with a very high level of outstandings relative to New Zealand history. Relative to other countries, we're actually not too bad, but relative to our own history, it's the largest we've ever seen in terms of how many government bonds there are outstandings. Recently, we've seen a bit of a shift whereby, with prudent fiscal behaviour from the government, and the aftermath, as we get further and further away from the pandemic, the issuance is not just going in one direction upwards. It's now starting to turn the corner, and we're seeing some stabilisation in issuance. So at the very latest update, which was the half-year budget, like we call it the half-year, or the high EFU as an acronym, that was in December. Surprisingly, the Treasury reduced their projections for how much they're going to borrow, how much they're going to issue this year and next year by $3 billion in each case. So this year's program was originally $38 billion. They reduced it to 35. And same for next year, they've reduced that as well. It has also meant things like, they were going to, they do these things called syndications, which are large one-off borrowings. Their typical borrowing channel is through these weekly tenders where they borrow, fairly steady amounts each week. But on top of that, they can raise very large amounts of billions all in one go through these things called syndications. Well, they cancelled the last syndication for this financial year. So those things, that improvement in the issuance outlook and the borrowing outlook, just meant that there were less government bonds going to be around than the markets had expected, and that was a positive surprise, and that supported government bond sentiment as well. So you've got issuance, you've got the outright yields and relativity to swap rates, and you've got the steep curve with nice carry and roll, all contributing to the attraction of New Zealand government bonds. And so, globally, the investors do like Kiwi government bonds at the moment, and I'd expect that to continue for at least the next quarter or two.
Just finally, Imre, geopolitical factors. So there's a lot of flashpoints and potential flashpoints around the world. I mean, overnight, for example, the US shot down an Iranian drone. This was sort of in the news, so that's one area. But rather than looking at a specific area of tension or issue, what is it, I guess, that would really spooks financial markets in terms of geopolitics? Like, what is it in particular that markets react to? Well,
the regional type crises that you get, for example, US Iran, we'll call that regional. It's largely confined to the Middle East, and that largely affects the markets that are tied to the Middle East, namely oil. So you tend to get something like that would affect oil prices, and it has done. So you've had, a thawing of tensions, and then you had a resurfacing last night when the drone got shot down and stuff like that. So that'll give oil markets a lot of volatility, but the spillover to things like global interest rates and global currencies is not as large as it used to be. I think markets are becoming a little bit desensitized to those things. Yeah.
Well, look, Imre, thanks so much. Appreciate your time. That's Imre Speizer, Head of New Zealand Strategy at Westpac, and I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.